Mr. Kalyani, good having you. Thanks much for joining in. Tough quarter, arguably tough times as well. Is there a positive that we can derive out of these numbers, Mr. Kalyani?
Two, three things. Number one, as I had said even during the last quarter review, we expected to have the second half to be pretty difficult. And I think that's exactly what we are seeing because the domestic market is difficult from a demand point of view. And the good thing is I think we have bottomed out on this, and going forward we are beginning to see some growth taking place. So I think that's the positive from this. In terms of our business, we are seeing a lot of positive traction on the pass car related business, and there we are seeing growth even now, and I think that growth will continue going forward. So this is as far as the domestic business is concerned. External business, again, has been a very disappointing quarter for us, and we have taken a lot of actions. Again, as I had said last time, we are moving more towards changing our product mix from steel to aluminum. We believe the future is in the chassis-related business in aluminum because that is irrespective of whether it's an IC engine or an EV, you still need these components, and that's where we are good at, and that's where we are focusing. And we are beginning to see a lot of good things happening there, but we have to restructure our business in Europe to move it to aluminum, and we are doing that, and we will see in this year, 2020, a much better performance coming out of there too.
Mr. Kalyani, just to dwell on that point a little bit more, you've stated your intention of becoming a more diversified forgings player with marquee global clientele. How is the global environment at this point? I mean, which also pertains to, leads to the question as to future visibility of this particular segment doing well for Bharat Forge.
It's something like this. If you don't do anything else and remain exactly where you are, the global environment is extremely difficult. But we have not been doing the same thing and being where we are. We have invested heavily in technology, in knowledge, in many other things, and because of that, we see many new opportunities in the global environment, especially on the pass car side, especially on the chassis side. And I think we will continue to see growth there, which many other companies may not be able to see. So we are quite confident that we will grow. If you look at the traditional business, the CV business, obviously the numbers tell you what the story is. The Indian CV business is down 50-60%. The global CV business is down 35-odd%. And it's a cyclical business. Globally, it's a cyclical business. I expect next year, 21, the cycle to start coming back. But that's a known phenomenon. That's no surprise as far as we are concerned.
So in terms so in terms of revenue visibility from these new capacities and the shift to platforms-based model, what kind of revenue visibility do you have in the upcoming few years?
No, I think I would only say this, that we will start seeing growth. And if you look at the pass car side, we are pretty much well entrenched with all the new players in India on the pass car side. We're getting entrenched with all the global players on our aluminum business. We expect the aluminum business to grow in Europe from a 50-60 million euro business to over 200 million euro business in the next 4 or 5 years. So that's the kind of growth that we are seeing. And that's a trend in the marketplace. And except that this requires very specialized technology, and we have this technology because we have invested in this technology in the past few years.
Do you see a feasible growth rate of 10% as per what most analysts have been pegging in with your new capacities and new products? From there, a 10% growth is expected. Is that conservative, or you think that's slightly aggressive and you may fall a bit short?
I think, going into FY21, we should look at those kind of growth rates. But if you look at our track record for 20 years, we have had much higher growth rates cumulatively. So I would expect, if you look at the next 5 years, then we should see a little better growth rate. But for next year, I think somewhere in the 10% range is a good range to target.
Okay, and industrial forging, sir, I believe, you are industrial forging, the share in industrial forgings is also climbing, jumped to about 26% this year from 17% just a few years ago. Your global clientele is pretty strong, Boeing, Rolls-Royce. Do you feel the segment expanding more, and what kind of share are you expecting this to capture?
We will continue to increase our presence in the global engineering business, the clients that you talked about, global Rolls-Royce, Liebherr, etc. That's in the aerospace side of the business. We have a pretty good strategy on the aerospace side of the business to keep growing, except, with aerospace is a very cautious OEM in terms of all the problems that you have seen in the last 2 years happening. So it takes time to grow that business. And we are not growing in the aerospace business on the structural side or on the low technology side. We are growing the business in areas where we have strength, and that is metallurgy, metallurgical technology, high machining technology, those kind of things, digital technology. So that's the area where we are growing. And we will definitely grow in this segment. This segment will become a reasonable segment for us in the next 4 odd years.
Just one question from my side with regards to margins this quarter, which took a beating despite better than expected gross margin performance on account of significant negative operating leverage benefits that came in. Put pressure on the margins? And also, are you expecting to see other expenses and employee costs coming under control in the upcoming quarters?
Yeah, I think in the next few quarters, employee cost takes time to get into shape because it's a complex process here to follow. But we have a massive cost reduction plan, and that's going exactly as per plan. And we will get on the operating side, our manufacturing costs are pretty much under control, even with lower volumes. We have done a good job on cost reduction, and we are doing the same thing on the fixed cost reduction. And as we see a small uptick in volumes, I think we should start seeing expansion in our margins.
Mr. Kalyani, just one question from my end. The cash in the books, of course, has grown this year. It's at 1930 crore, and even the long-term debt has gone up, as a result of which we've seen the finance cost for the quarter at least were higher on year-on-year basis. Could you just give us a sense with regard to debt reduction plans, and also how do you plan to deploy the cash which is there on the balance sheet right now?
Two things. As far as debt is concerned, we have a repayment in this quarter of 200 crores, so the debt will go down. As far as interest cost is concerned, the interest cost that you see in the numbers is half of that comes from the revaluation of debt because the rupee got depreciated in that quarter, and you will see exactly the reverse happening this quarter because the rupee has slightly appreciated. And with the new regulations, accounting rules, a large part of loan revaluation sits in interest costs.